The recent inflation numbers show the economy slowing down, but American families are getting stretched to their limits. Let's find out what it means for the economy and for you. All right, guys, this past week, the Bureau of Labor Statistics posted the CPI numbers. CPI, of course, stands for Consumer Price Index, and it really tracks the changes in prices for consumers over time. The first thing to talk about is what exactly is the Consumer Price Index? What are we tracking? So to track consumer prices, we look at a basket of goods. This basket of goods is supposed to be a representative sample of the things that consumers buy in the economy. So what's included in the basket? You have, broadly speaking, food and beverage, housing, apparel, transportation, medical care, recreation, education, and then other goods and services. Now, there is an important distinction. There are two types of inflation that are typically quoted. The first one is headline inflation, and the second is core inflation. Headline inflation includes all of the things I just mentioned in that basket of goods. This is generally thought of as a good metric to see how the cost of living is changing for American consumers month to month and year to year. So the headline inflation number includes all goods and services in that basket of goods. This includes both volatile and non-volatile goods, including things like food and energy, which tend to be more volatile. So this is a more comprehensive approach than just the core CPI. So what's good about this is that because it's more comprehensive, it's a more broad approach to track changes in the economy over time, and is really a better figure to show how the changing prices are affecting average American consumers on a month-to-month or year-to-year basis. And then, of course, on the other hand, you have core CPI, which is another figure you hear talked about quite a bit. Core CPI takes out the volatile aspects of that basket of goods, namely food and energy, right? Food and energy are volatile because sometimes food can be subject to seasonality, or energy can be subject to, whatever the Saudis want to do with the oil market that week. And those things aren't necessarily driven by the state of the United States economy. So to get core CPI, we net out things like that. So core inflation is useful to policymakers and economists when they're trying to understand a more long-term inflationary trend, because it filters out all the noise in the data caused by food and energy. It allows people like the policymakers at the Federal Reserve to have a better idea of what they should be doing in terms of monetary policy. So that brings us to this past week. So what happened with inflation? So the first number we'll talk about is the headline inflation number. It was basically flat in October, so no real change month to month, but it's up 3.2% from a year ago. Now, this was slightly better by 0.1% than Wall Street estimates, and so the stock market went crazy on the good news, even though it beat it by 0.1%, which is probably within the margin of error. At the same time, core inflation, which does not include food and energy, rose 0.2% month over month, and more importantly, 4% year over year. So, core inflation's 4%. Things are 4% more expensive than they were a year ago. Wall Street's having a party, stocks rallied, but your cost of living is still 4% more than it was last year, and that's double what the Fed's target rate of inflation is, which is only 2%. As we spoke about last video, should the target rate of inflation be 2%? That's a whole subject for a different video, but even at their stated rate of what they want, we're still double that. So yes, inflation has come down according to how the government measures it, but they're still quite a ways away from where they want to be. Now, discussing these inflation numbers, it also brings up the fact that whether or not we should even be believing the government CPI numbers. There's inherent government bias when you look at these numbers. I mean, they've changed the way they report these numbers many times over the years. If you go back and look at the way they reported CPI back in 1980 and 1990, and you apply some of those same formulas to today, the numbers for inflation would be much, much worse. So to get a better idea of what inflation actually is, there's a website I like to use called ShadowStat. It's run by a guy named John Williams, who basically does his own methodology, but he takes the inflation number and he calculates it based on the way that our government used to calculate inflation back in the 80s and the 90s, and they've changed the formula in terms of how they calculate inflation many times. And lo and behold, inflation seems to get lower and lower the more they manipulate the formula. So the actual real reported rate of inflation is probably closer to what John Williams reports on Shadow Stats as opposed to what the CPI is reported as by the government. Now, John Williams' stuff is not without criticism. He has his own ways of identifying differences in quality and substitutions over the years. And so even if you don't think that his numbers are absolutely correct, it's probably closer to his number than the actual real reported government number. And I would argue that if you ask the average American who actually goes to the supermarket or goes to the store to buy things, they would probably agree with him more than the Bureau of Labor Statistics. The key takeaway here is that even if inflation is coming down, all that's coming down is the actual rate of inflation, right? Prices are not coming down. prices are still 3 to 4%, depending on whether you're looking at headline or core CPI. They're still that much more expensive than this time last year. And they're that much more expensive than the already high price of last year. So Fox Business came out with a report that the high prices from post-COVID inflation are here to stay. Americans are paying an extra $680 per month compared to this time 2 years ago. So yeah, even though the inflation's gone and the government's going to champion that as some kind of win, the high prices that came with the inflation are here for good. So as we talked about last week, we were wondering whether or not the Federal Reserve was going to be raising interest rates on their last Fed meeting. Ultimately, as expected, they did not raise rates. But now that the inflation number has come in and the inflation has cooled a little bit, according to the government, what's really interesting is now you see people calling for interest rate cuts going into next year. So interestingly enough, CME Group, they have a useful tool called the Fed Watch tool, and basically it uses futures contracts on the Federal Reserve rates to calculate probabilities as far as whether or not they think, or the market thinks, that rates are going to go up or down. And if you look at the graphic on the screen now, they think that there's actually a 2 in 3 chance that the Fed cuts rates by May 2024. So we were just talking about whether they're going to raise rates last week. Now with the inflation number in, people are starting to talk about cutting rates. I'm not quite buying that. Now, me personally, I think the Fed's in a bad spot here because I don't think that they can claim victory against inflation yet. Yes, we had one decent inflation number if you believe their inflation number, but I don't think inflation's done with. I really think they are going to want to cut rates going into next year because the economy will likely be in recession and Americans will really be feeling the squeeze as we have inflationary pressure pushing prices up, stretching consumers thin, and lower rates will be good for the housing market. They'll be good for people paying credit card debt and all other sorts of consumer debt. However, lowering rates next year would mean that the Fed is going to be putting more upward pressure on prices. So they have this tug of war between keeping rates high to battle inflation and lowering interest rates to get the economy going back out of recession. We can be stuck in kind of no man's land where they're going to be screwing somebody, consumers with high interest rates, or inflation is going to be here with low rates. All right, so last week we talked about the GDP number and why I thought that maybe that wasn't all it's cracked up to be, and you have to look a little bit deeper than the headline number. So in addition to credit card debt topping $1 trillion, as we mentioned last week, approximately 8% of credit card balances have now transferred into 30-plus day delinquency. 8%. That's the highest level since just after the 2008 financial crisis, somewhere in 2011 or 2012. That's the last time that percentage rate was that high. Americans are really getting stretched thin here on the consumer debt. And you can see from the graph on the screen, auto loan delinquencies are not far behind as well. Those are also at levels not seen since just after the last Great Recession. So that brings up the question, how are Americans getting by? If they're putting more and more money on credit cards, if they're making more and more delinquent payments, what are they doing to get by? And we saw this article on investing.com. Bank of America data shows rise in 401k hardship withdrawals are due to inflation. So an increasing number of people are taking hardship withdrawals from their 401ks. Hardship withdrawals are up 27% since the beginning of the year. That means these people are needing to pay tax and penalties on their retirement savings, and obviously foregoing the opportunity cost of letting that retirement savings grow for the next 30 years into retirement to take care of short-term obligations now. And so with Americans being stretched thin like that, it should come as no surprise that this past month, retail sales were down for the first time since March, and for the past 5 months, consumer savings rates have been decreasing. Personal saving rates are now down to 3.4%, which is their lowest level in 5 months. So it's all bad news this week, right? Well, not exactly. Mortgage interest rates are down. So because inflation's down, and we talked about last week how inflation is one of the drivers of mortgage rates, because inflation's down, mortgage rates are down a little bit. That, and now there's the prospectus of the Federal Reserve possibly lowering rates in the future. That seems to be the sentiment on Wall Street and amongst traders. So mortgage rates have fallen to their lowest levels in the past couple months. So if you have been on the sidelines, either looking to buy your own home or to buy an investment property, you have a little bit of a reprieve on the rates here. So how long that's going to last, I don't know. What I'm really curious to see is if we get our next inflation number, if it's also quote unquote good. That might further push mortgage interest rates down. I don't think that that's going to happen, but we'll have to wait and see. All right, guys, that's it for me on this episode. Please like, subscribe, and ring that notification bell. And if you are an investor, a real estate investor, please find my contact info down below. I finance fix and flips and no-doc rental loans for your rental properties. I would love to chat with you. And again, that's it for us today, and we will see you in the next one.